All right, let's be honest for a second. Compounding kind of sucks in the beginning, right? You put your money in, you do all the right things, you stay disciplined, and it just feels like you're spinning your wheels going absolutely nowhere. But what if I told you there's a predictable point where everything flips? A moment where the numbers stop crawling and just start exploding. Well, today we're going to dive into exactly that. This is the 7531 rule, and it's the framework that shows you exactly when that magic happens.
We've all asked ourselves this question. You look at your account after a few years of saving and you just think, is this it? Is this all there is? That question right there is probably the single most dangerous question in all of investing. And it's the exact moment most people give up, usually right before things are about to get really good.
So let me tell you about Veronica. For 5 straight years, she was a rock star. She invested $200 every single month, didn't miss once, did everything right. And her balance? Just $14,000. She was totally demoralized, ready to quit. But here's the thing, Veronica wasn't doing anything wrong. She just hadn't hit that breaking point yet. And understanding that point, well, that's the difference between quitting with a small sum and building some serious, life-changing wealth.
I love this analogy because it just gets to the heart of the matter so perfectly. Think about trying to push a car from a dead stop. At first, you're just straining, sweating, putting all your weight into it, and the car is barely moving an inch. That's your first few years of investing. But once you get it rolling, the momentum starts to take over and it becomes almost effortless to keep it going. The 7531 rule is what tells you exactly how long you need to keep pushing.
Okay, so let's break this rule down, starting with that very first number, 7. We're talking 7 years. You've got to think of this as the minimum amount of time you need to commit before compounding even starts to feel like it's working. This is the length of your push.
And look, this isn't just some random number we pulled out of thin air. The data is crystal clear. If you invested in the S&P 500 for any random 1-year period, historically you had about a 74% chance of making money. Not bad. But if you stretch that out to any 7-year period, your chance of a positive return skyrockets to over 95%. See? 7 years is what smooths out all the crazy ups and downs and puts the odds overwhelmingly on your side.
You know, committing to 7 years really forces you to make a huge mental shift. You stop being a gambler who nervously checks their account every day like it's a scratch-off ticket. Instead, you become a planter. You know, you don't dig up a seed every week to see if it's growing. You trust the process. You know, you don't judge a tree by how tall it is in year 2. You judge it by the fact that it's still growing strong in year 7.
Okay, so having a long timeline is crucial, but it's not going to do you much good if your foundation is shaky. And that brings us to our second number. 5. We're talking about building your portfolio across 5 distinct categories of assets. This isn't just about diversification. This is about building a financial shock absorber. And this chart illustrates that structure just beautifully. Notice the balance here. About half your portfolio is this solid core in broad market funds. Then you're adding these other slices for different jobs. A slice for income with dividends, one for high growth with small and mid caps, another for global balance with international funds, and, so important, a safety net with defensive assets. It's not a random mix at all. It's a structure that's actually built to weather any storm the market throws at it.
Let's think of it this way. Every single category has a very specific job. The broad market, that's your engine. Dividends, they provide a nice steady cash flow. Small caps are like your turbo boost. International exposure makes sure you're not putting all your eggs in one country's basket. And those defensive assets, well, those are your brakes and airbags. When they all work together, you've got a super resilient system where something is always working in your favor.
All right, so you've got the right timeline, you've got the right portfolio. But guess what? The biggest enemy is still out there, and it's staring back at you in the mirror. It's your own brain. This brings us to the number 3. 3 predictable emotional phases that are practically designed to wreck your progress.
This right here, this is the map of the emotional battlefield. In those first couple of years, you're going to feel doubt, just watching your balance barely move. Then, around years 3 and 4, that doubt morphs into frustration, because you're seeing this slow, straight-line growth instead of the exponential curve you were promised. And then, inevitably, the market will crash, and that's when pure panic sets in. Just knowing these feelings are coming is honestly half the battle.
So how do you actually win this mental game? With a system. First, for the love of all that is holy, stop checking your account every day. Second, automate everything. Set it and forget it. Third, change your metric for success. Celebrate your consistency, the fact that you contributed, not just the market return. And fourth, become a student of market history. You'll learn that every single crash in history has been followed by a recovery. Knowing that turns panic into opportunity.
We've built the foundation.
We've prepared for the mental battle. Now it's time to light the fuse. This is the final number, and honestly, it might be the most powerful of all. 1. We're talking about one small annual increase in your contribution that can be the difference between having moderate wealth and having truly life-changing wealth.
Just look at these numbers. The math is absolutely staggering. If you invest a flat $300 a month for 30 years, you end up with around $408,000. Hey, that's not bad at all. But if you increase that contribution by just 5% each year, we're talking only an extra $15 a month in year 2, your final balance nearly doubles to over $787,000. It's insane. This one tiny little tweak just supercharges the entire system.
So that's the rule, 7-5-3-1, a 7-year commitment, a 5-part portfolio, surviving 3 emotional hurdles, all powered by one annual boost. Now let's look at the real-world proof of what happens when you actually put it all together.
Let's go back to Veronica. Remember her? The one who was ready to quit with just 14 grand? Well, what if she hadn't quit? What if she adopted this rule instead? Fast forward to year 30 and she's sitting on over $500,000. And get this, her account grew by over $300,000 in just the last 10 years alone. That's the compounding curve finally waking up and taking over. Or take a look at Tom and Jake. They both start at the exact same time with the exact same amount of money. Tom follows the 7-5-3-1 rule, stays the course, and ends up with $750,000. Jake gets emotional, he panics during downturns, he stops and starts his contributions, and he ends up with less than half of that. Same starting line, but a disciplined system created a completely different universe for their finish lines.
And it's not just stories and anecdotes. The hard data from all the big financial institutions backs this up at every single level. Fidelity found that investors who stick with it for 7+ years have 60% higher balances. Dalbar has proven that emotional investors earn about half the market returns. Vanguard showed that proper diversification cuts down on volatility. And Schwab confirmed that even a tiny 1% annual contribution increase can have a massive impact. The evidence is it's overwhelming.
Okay, so the why is clear. The proof is there. So let's pivot to the how. Because this isn't just theory. It's an actionable plan you can put into place the second this is over.
Here it is, step by step. Number 1, make a non-negotiable commitment to 7 years. Seriously, write it down. 2, rebalance your portfolio into those 5 core categories. 3, automate your contributions so that willpower isn't even part of the equation. 4, write down your emotional playbook now before you need it. And 5, go in your calendar right now and set a recurring reminder to increase your contribution by 5% every single year.
And that really brings us to the most important takeaway of all this. That slow start of compounding, it isn't a bug. It's a feature. It's a filter designed to weed out the impatient and massively reward the disciplined. The 7-5-3-1 rule isn't just a strategy. It's the filter that makes sure you end up on the right side of that equation.
So look, the math guarantees it. Decades of historical data support it. The system itself is proven to work. There is only one variable left in this entire equation, you. So the real question is, what are you going to do about it? What's your next move?